The economy is like a massive ship, slow to turn but impossible to ignore when it's heading for rough waters. Right now, there is plenty of turbulence ahead. Trade wars, unpredictable policies, and growing uncertainty have left businesses and consumers bracing for impact. And with the risk of recession looming, it's time to take a hard look at where things are headed. Tariffs have long been used as a tool in economic policy, but under the Trump administration, they became a central strategy. Whether it was targeting China, Canada, or European Union, these tariffs were positioned as a way to protect American industries. But did they actually work? On the surface, tariffs might seem like a strong move. Taxing foreign goods should make domestic products more competitive, right? Not so fast. The reality is that tariffs create economic ripples that affect businesses and consumers alike. When tariffs go up, companies that rely on global supply chains face higher costs. Those costs get passed down to consumers, making everyday goods more expensive. Businesses unsure of what comes next hold back on investments, slowing down job growth and economic expansion. This uncertainty is dangerous. Companies like automakers, tech firms, and even small manufacturers have been forced to rethink expansion plans because they don't know what the next policy move will be. And when businesses stop investing, economic momentum slows. Historically, economic slowdowns driven by uncertainty have been early warning signs of a coming recession. If you are finding these insights valuable, don't forget to like and share this video. It helps bring more people into the discussion. Recessions don't happen overnight. They build up over time, often fueled by policy missteps and external shocks. Right now, some key warning signs are flashing red. Business investment is slowing as uncertainty surrounding tariffs has frozen expansion plans. Companies are hesitant to spend money on new projects or hire more workers when they don't know what trade policy will look like next year. At the same time, consumer behavior is shifting. People tend to save more and spend less when they feel the economy is unstable. This cautious approach can slow down growth, making a recession more likely. And then there is the Federal Reserve, which typically cuts interest rates to stimulate growth when the economy is slowing. But with rates already low, the Fed has limited tools left to fight off a downturn. Looking back at 2019, we saw similar trends: tariff fears, an industrial slowdown, and an eventual need for the Fed to step in with rate cuts. Now in today's climate, those same ingredients are back on the table, making the risk of a recession in the US and Canada all the more real. The Federal Reserve is in a tough spot. Its job is to balance inflation and economic growth, but tariffs throw a wrench into the equation. Higher tariffs mean businesses face rising costs, which can lead to inflation. But at the same time, the economic slowdown triggered by trade uncertainty could push the Fed to cut rates in an effort to boost growth. If the economy continues to weaken, we might see the Fed slash interest rates down to 1% or lower, just like it did in 2019. In Canada, the Bank of Canada may have to follow suit, cutting rates to support growth. But here is the problem. If rates are already low, central banks don't have much room left to maneuver in case things get worse. What do you think? Should central banks step in aggressively, or should they let the economy work itself out? Drop a comment below and share your thoughts. Beyond monetary policy, there is another tool in the government's playbook: fiscal stimulus. Unlike interest rate cuts, which make borrowing cheaper, fiscal stimulus involves direct government spending to boost the economy. And right now, there is a strong case for using it. The US and Canada both have room to deploy fiscal measures to offset the damage from trade policies. Infrastructure spending, targeted tax cuts, or direct support for industries affected by tariffs could help stabilize growth. Some have suggested that Canada should take a more aggressive stance against US tariffs. This could include placing export bans or higher taxes on key resources that the US relies on, effectively using trade policy as leverage. Would such an approach force a change in direction from Washington? It's hard to say, but one thing is clear. Without a strong response, these trade tensions could have long-term consequences. Short-term fixes can only do so much. In the long run, both the US and Canada need strategies to strengthen their economies against future trade shocks. One major area of focus should be the corporate tax policy. By lowering corporate taxes to more competitive levels, Canada could attract more foreign investment, something it has struggled with in recent years. Another key factor is labor productivity. Instead of relying on tariffs and trade restrictions, increasing productivity through technology, education, and innovation would provide more sustainable economic growth. Countries that invest in these areas are better positioned to handle external economic shocks no matter what trade policies are in place. In times of economic uncertainty, investors look for safe places to put their money. One asset that consistently gains value during turbulence is gold. When stock markets fluctuate and inflation rises, gold tends to hold its value, making it an attractive option for those looking to hedge against risk. Right now, many investors see gold as a crucial part of a diversified portfolio. If uncertainty continues, we could see a long-term bullish trend for gold. For those who haven't considered it before, now might be the time to start paying attention. Trump's tariff policies have reshaped the global economic landscape, but whether they have helped or hurt is still up for debate. What's clear is that uncertainty remains a powerful force, and if businesses and consumers continue to feel uneasy, a recession could become a reality. The next few months will be critical. Will trade tensions ease or will they escalate further? Will central banks have enough firepower to prevent a downturn? And will governments step in with a stimulus before it's too late? If you have made it this far, don't forget to like, subscribe, and ring that notification bell for more deep dives into the economy. Thanks for watching.